I sincerely believe that actually we're going to have a serious monetary event that's going to lead to, these sound money things trading in a different zip code than they trade in right now. Gold could be 4,000, 5,000, 10,000. Bitcoin will be north of 100,000. Silver will be north of 75. I mean, I think that's going to happen. And the reason it's going to happen, in my opinion, is that the people controlling the money, the monetary stewards, the Fed, et cetera, are slowly but surely losing their credibility. And the history shows that hyperinflation or high rates of inflation occur when people lose confidence in the ability of the monetary authorities to control.
Gold prices in the international market traded lower on Thursday, extending their fall for the third consecutive session after Federal Reserve Chair Jerome Powell reiterated a hawkish stance indicating more interest rate hikes ahead. Beginning with its first hike in March 2022, the Fed has increased its benchmark interest rate to between 5% and 5.25%, its highest level in 16 years, before foregoing a hike at its most recent meeting in June. On Wednesday, Powell suggested that the Fed could slow its rate hikes to a pace of every other meeting. However, he cautioned that the central bank's policymakers have yet to agree to that. Moderating their pace of rate hikes would allow Fed officials to better gauge how the economy has been affected and avoid tightening credit so much as to tip the economy into a painful recession. However, the Fed's hawkish stance could be reversed in the second half of the year if inflation starts to come down. In such a scenario, gold prices could rally significantly, as investors would flock to the asset as a hedge against inflation and economic uncertainty. Lawrence Lepard, the founder of Equity Management Associates, LLC, believes that gold could hit $2,400 or even $3,000 if there is a Fed pivot. He argues that a shift in the overall economic trend could be triggered when the consensus concludes that the Fed cannot continue its tightening program and might have to resort to cutting rates and implementing quantitative easing. Now let's watch excerpts from Lawrence Lepard's interview with Soar Financially. Be sure to watch the entire video and consider subscribing to our channel. Remember to enable post notifications to stay updated on our latest uploads. Thank you, and enjoy the video.
One, I don't think 2023 is a lost year yet. I mean, we're, late June now, so we're halfway through the year, and a lot can happen in a year. And so that I would start with that. And then two, I would say, he's got to say that. And yet the market, the gold market is kind of saying, yeah, bullshit, pal. If they really believed him, gold would be 1750 or 1800 or 16 something. So, some people believe him, and that's why we've had a sell-off. That's why we're not at new all-time highs. But I don't think everybody believes him. And so, it's a tug of war as we wait to see, and what's got to happen is the consensus has got to come to the conclusion that they can never really do what they're talking about doing. Because if they do, this debt doom loop is just going to get bigger and be more and more of a problem. And so, they will, in my opinion, they will pivot, but only when forced, probably only when forced to. And so, what could force them? Who knows? When the consensus becomes the Fed cannot continue this tightening program, and in fact is either done tightening or is even looking at possibly having to cut and return to QE, which I think they ultimately would be forced into. At that point in time, this is going to run incredibly hard in the opposite direction, and gold's going to take out 2050 with authority. And it's not just going to 2100, it's going to 24, 25, 27, or 3000. And the gold stocks will go bananas. I mean, they'll go up 100%, within months, as we've seen them do in the past when you get these shifts in the overall monetary trend. But, they're higher beta than anything else. It's a tough business. You're breaking rocks. And, the bottom line is people are either in love with them and they go crazy to the upside, or they hate them and there's just nothing but sellers and they just kind of dribble away their value. And by the way, I mean, it's like bull markets are designed to throw off all the riders. I mean, if you're riding the gold stock thing, I mean, you're feeling pretty sick about it all right now. And a lot of people I know are capitulating and selling. I'm not. I'm holding everything I've got, and to the degree I've got something that's good, I might sell it to buy something that's cheaper, because I'm quite convinced that when this thing does shift, and it will, in my opinion, sometime within three months to a year, the stuff's going to go bananas. It's going to go absolutely bananas to the upside. So So I'm pretty bullish about all of that. But it's, look, there's nobody who says this has been fun. And I think we're on the cusp of a very, very big monetary event. I really do. I mean, it's been, we've seen it coming for a long time. 2000 was a bubble, 2008 was a bubble, 2022 was a bubble. I personally believe the stock market put in a peak at the tail end of 2021, December 2021. And the first down leg in 2022 was the down leg that we've now got a bear market rally that I think is fooling everybody and sucking everybody in. And I think, higher inflation, margin compression, PE multiple compression. I mean, it's an echo bubble because everyone thinks AI is the new big thing, right? Okay, fine. But my view is this bubble has burst. The free money bubble that was created by ZERP from 2008 to 2015, that's burst. And so, now we're just trying to figure out where are all the bodies. First Republic was a body. There are a lot of other banks that are bodies. There's a lot of commercial real estate. There's a lot of private equity. I mean, I think you're just going to find, money is going to get tighter in a lot of different places. And stocks are going to go down in value. You're going to have a negative wealth effect. And the point is that, if you look at the last the reason why I think we've hit the bottom of the Powell tightening cycle is, I think we hit it last October, November, when I think gold touched like 1675 and Bitcoin was at 15,000. Well, Bitcoin's up at 30,000 now. So Bitcoin, since last fall, Bitcoin's up 100%. To me, that's a leading indicator. I don't think we're going back to 15. And gold's up too. Gold was called 1675. Now it's 1925. Gold's up. So I think and the gold stocks, while they're beaten down pretty bad, they're not going down as fast as they used to, and they're kind of scratching around for a bottom. So I think we've kind of turned the corner on how bad this is going to get.
Moving forward, Lepard expects the dollar's value to decrease in the next 5 years substantially. The BRICS countries have been pursuing a wide range of initiatives to decrease their dependence on the dollar. Over the past year, Russia, China, and Brazil have used more non-dollar currencies in their cross-border transactions. Iraq, Saudi Arabia, and the United Arab Emirates are actively exploring dollar alternatives. And central banks have sought to shift more of their currency reserves away from the dollar and into gold. Regarding the stock market, Lepard holds a bearish outlook. A decline in the stock market can negatively impact the overall economy. Stocks closed lower last week, with the S&P 500 falling 1.4%. The index is now up 13.3% year-to-date, up 21.6% from its October 12th closing low of 3,577.03, and down 9.3% from its January 3rd, 2022, record closing high of 4,796.56. Let's get back to the interview.
Hyperinflation or high rates of inflation occur when people lose confidence in the ability of the monetary authorities to control the situation. And I think that loss of confidence is in the process of occurring. And Powell's trying to restore it with these high rates, saying he'll get inflation under control, et cetera, et cetera. But those of us who look at it analytically say, mathematically, he can't do what he's trying to do. I mean, he can for the short term, he can try, but guess what? If he does, half the banks in the United States are going to fail. You know what I mean? And the U.S. federal government is going to spend $1.5 trillion a year on interest, and the U.S. federal deficit is going to be $3 trillion. Oh, and by the way, have you noticed, Japan's not buying our bonds anymore. China's selling our bonds. England's not buying our bonds anymore. Oh, and by the way, all the BRICS are getting together trying to create their own currency. I mean, not that that'll be a real threat in any time soon. I mean, that's got a million problems to be worked out. But the point I'm trying to make is the dollar value relative to other things needs to and will go down very substantially, in my opinion, in the next 5 years. I think. And I think they've even come out and said that. I mean, even, Yellen even said something along the lines of, well, maybe the dollar doesn't need to be the only reserve currency, and we could see it decreasing over time. I mean, I think the U.S., in order to hold the system together, absolutely must weaken the dollar. Very similar to the way they've done it in the past when they needed to hold the system together. So, and that means against other currencies, but they're all paper too. And what it really means is against stuff. And so I see much. I think we reached peak deflation, in March of 2020. That was the peak deflation. We had 41 years of deflation. The 10-year at one point, I think, was like 50 bips, which is a joke. And so now we've turned that corner and we are in an inflationary trend. And I think it's going to be years to run. It's going to be very bullish for gold, silver, and commodities, very bullish for oil, etc. But having said that, and I encourage everyone to Google the Myrmikan Weimar chart, and it shows the red line. Even in an inflationary environment, you get deflationary impulses where, the government says, oh, no, we're going to stop all this inflation. Uh-oh, okay, I don't need any gold. I'll sell my gold. Okay, I'll go buy the stock market, etc. So, and we're in one of those right now, and it feels shitty, but it's not, it's not going to last. It just can't last. What's the hardest thing to do right now? It's to buy gold and silver mining stocks. It's brutal. I mean, everyone would think, shit, I'm not touching that stuff. Look at how badly it's done. Well, no. I mean, the buying opportunity here is unfriggin' believable. But, most people don't see it, or they're scared of the last 2 years' performance. They're like, I'm not touching that. And
No.
I'm buying AI. I'm buying NVIDIA. NVIDIA's on fire. Okay, you're paying 19 times revenues. Let's see how that works out for you. I don't think it's going to get better for it. I don't think it's going to get better for stock market investors in general. I'm pretty bearish on the stock market. I mean, I don't see a lot of good things going on here in this economy and in commercial real estate and housing and cars. Stock market is very much, the consumer spending is very much driven by the stock market. A lot of people who have money, they're always looking at the stock account to feel, oh, I've got enough money. Yeah, I can take that vacation. I can buy that car. And, when the stock market goes down as it did, in 2022, you can get into a real, problem in terms of the economy. And I think that's where we're going.
Gold prices are likely to fluctuate in the near term as investors weigh the possibility of a slowdown in inflation against the Fed's hawkish stance. However, if inflation does start to come down, gold prices could rally significantly, as investors would flock to the asset as a hedge against inflation and economic uncertainty. Do you think gold prices will continue to fluctuate in the near term? Please share your thoughts in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.